because diversification is becoming relevant again. And this is something that I talk about all the time is like, why is this?
Hello, everybody. This is Josh Flade with the Building Better Portfolios podcast with my co-host, Paisley Nardini. And this is Quick Takes episode 3. Hope everybody's excited. This will be 15 minutes or less. So let's dive in, Paisley. The question we are going to be exploring today is, does diversification dilute potential returns?
This is an exciting topic for me. I've worked in the multi-asset world for probably the last decade, and we continue to hammer home the importance of diversification, which has actually been really difficult to do the last couple of years. If anybody's been paying any attention to the markets, it's been a bloodbath if you've had a diversified portfolio. You've been penalized for diversifying your risks. So I think before we even dive into the question at hand is a little bit of backdrop of where we've come from. Let's go back to 2022. So three or so years ago, stocks disappointed, bonds disappointed. Those are your two primary drivers of return and risk in a portfolio, and they both let you down. So what did that kick off? Well, bonds underperformed. Those are usually ballast in your portfolio. So I think that's when really we started to see a lot of investors start asking this question of what's the importance of diversification? What is it doing in my portfolio? Or also more importantly, was it not doing? Because then what happened the next 2 years, Josh? Super concentrated portfolios.
Absolutely.
Yeah, tech stocks.
Yeah.
So,
and equity markets ripped, and they're ripping this year, and bonds continued to really underperform the following 2 years.
This question of does diversification dilute your return potential in a portfolio? Let's be very clear. The short answer is yes. But the answer is yes if you're really good at stock picking and your hindsight's 2020. And we all know, hopefully without ego, that we do not have the ability to look in the rearview mirror and come up with the best stock picks. And I think if we are honest with ourselves, professionals in this industry with massive research teams that have been doing this for decades, they can't outperform the market. So stop thinking that you can, and let's talk about the importance of diversification in the portfolio. So where we are this year, and Josh mentioned it, equities are still grinding higher. Bonds are doing a little bit better, but nobody's writing home about the bonds in their portfolio this year. So why I love 2025, which is a bit of a controversial statement, because equities were down 20+%. We had the tariff tantrum. We have all these geopolitical risks. So you're okay, you're a psychopath. Why do you love this year? It's because diversification is becoming relevant again. And this is something that I talk about all the time is why is this? Well, what is the benefit of diversification? It's going to smooth your overall portfolio volatility. Yes, it might sacrifice return on the upside, but what's important about smoothing portfolio volatility is that it protects your drawdowns. And that's ultimately what all this is about. So in essence, the question is does it dilute your return potential? It does. If you picked all the right stocks, none of us are going to do that anyway. So if you have less drawdown, you have more upside potential over time. And I want to come back to that question actually in a second. I'm going to turn the tables, Josh, and ask you that question as well. But just going back to the topic at hand, how many of us knew that international stocks were going to rip this year? And again, don't lie to yourselves. Don't lie to us. If that was the case, portfolios would have looked a lot different coming into 2025. We've all been underallocated international stocks for years now, and rightfully so. It's actually worked in our favor. But all of a sudden you have these things brew to the surface and they come out of left field. You have geopolitical risks. You have that tariff tantrum. Let's talk about gold. Gold is one of the OG portfolio diversifiers, and it has absolutely ripped this year, more than Bitcoin, more than equities, more than bonds, of course. And so what is this reminding us? It's reminding us that all of these levers within our portfolio are so important to help smooth overall portfolio volatility. So Josh, I want to turn the question kind of back to you in your seat, working with advisor teams and thinking about your role in kind of the CIO type focus. Why do you think diversification is important?
Yeah, it's a great question. And I like to think about it from a couple of different ways. One is you have the destination, You know that you're trying to help people retire. You're trying to help them fulfill their dreams and retire with dignity and enough money to do whatever they want to do, which is really important. So if that's the destination, now the question is okay, there's the journey. And I would say the journey is just as important as the destination. And why do I say that? Let me give you an example. I know somebody who in 2009, March of 2009, sold out of their 401k at that time. They did not buy back into the equity markets for 5+ years. So if they were probably over allocated to equities, maybe, right? Because bonds actually didn't perform that badly, right? Treasuries didn't perform that badly during that time. And so if the question is if that journey was so volatile, they actually could not stay in the markets. And that's why I think journey is so important. So if you can smooth that journey out for people, for investors, and that results in a higher probability of staying risk on in the markets for as long as they can. I think you end up getting to that destination that you ultimately want to get to. So I think
Very
that's
valid.
one of the biggest things is like, yeah, journey is just as important as destination. And by diversifying, you make that journey a smoother experience for everybody. And then I would say the other thing is really around, this is an old adage, right? But it's diversification is the only free lunch. And it is true. Yeah, exactly. So it's true. I mean, it's the only free lunch in the sense that you can create better risk adjusted returns for clients, which is risk adjusted returns is simply going back to that same idea. For every unit of return, how much risk am I taking? And that all goes back to that idea of the journey and the volatility and what clients are going to experience.
I'm putting myself in the shoes of people listening to this right now. And there's probably some people like, oh, boring, Josh. Like you guys are like talking about like risk adjusted returns and smoothing volatility. Like Nvidia's up like 8,000,000,000% in the last couple of years. Like what if I just would have had Nvidia? I could retire now, or if I timed Bitcoin, et cetera. Again, I would go back to like this premise or this idea that we can time markets. Like go ahead, try, let me know how you do. I would say even like very sophisticated institutional investors who work at some of the largest firms out there, they have said a lot of these kind of high flyer stocks that they've picked in their portfolios or the right call on Bitcoin at a certain time. A lot of it does come down to luck. And so if you are extremely lucky, like maybe you just go out and buy a Powerball ticket, go to the casino instead. But like over time, you're not going to consistently be lucky in buying and selling. Because again, if you want to actually lock in these gains, you got to sell. So that's two decisions you have to make right on one trade. And then you have to do that repeatedly over time to have that hindsight be like diversification penalizes you. And again, I think 2025 has been a stark reminder that even if valuations look a certain way or fundamentals look a certain way or macro data looks a certain way, like we have political leaders and figures, we have geopolitical risks, we have all of a sudden like massive infrastructure that gets thrown off guard that results in energy price fluctuations, like all these things that are unforeseen. And at the end of the day, it's like buying insurance. You buy insurance for unforeseen events. You don't buy house insurance because you think somebody's going to set your house on fire. It's because it could happen. And so that's how I almost view diversification. It's your insurance against these unforeseen events. And I think that's the importance, again, going back to Josh's comment, is the behavioral component of the psychology as an investor is like everything's hunky-dory when you pick that one stock that's up, 30% in a month and you get to tell all your friends and neighbors about it. But then when that sells off or there's a huge drawdown in that, like, are you going to stay in that until it comes back? Maybe, maybe not. And all of a sudden your long-term game plan is thrown off. And so think about now your entire investment life savings in making that type of like very kind of idiosyncratic risk or decision on one stock or one market, and then having to be right and time that appropriately. Like there's just way too many factors or components that's going to lead you to see very quickly that not diversifying your portfolio is not a great call. But I think this conversation is so important right now because we're coming off an environment where diversification has been the biggest thorn in the side of the portfolio. And that's why I'm so encouraged, despite all of the volatility that we've seen this year, that diversification is finally back in vogue.
I think there's another side of that coin of diversification, which is rebalancing. That's why you diversify. So that way, when stock markets are down 20%, you have something that is flat or maybe slightly up, or maybe it's just down less. And then you rebalance into these equities that are now relatively cheap relative to what they were. And I think that that's the other side of that coin. The other thing, I mean, you hit something on the head that I'm going to say in another way, which is, and I'll give you a little bit of background. I was speaking this week to 600 financial advisors at this conference, and I had a financial advisor ask me, because I shared a story about a firm that I was previously at where I would help other financial advisors. We had a trade desk, and we had financial advisors, a handful, not all of them. There's just a handful who always would sell out their clients' accounts into cash at the bottom of the market. I mean, I'm talking 2020, multiple times, right? 2022 and I had standing instructions with the trade desk. And I said, hey, when this advisor or this advisor or this advisor calls to sell their clients' accounts to cash, I want you to call me. And so that way I could put my own money in the markets, because it was like the perfect contrarian indicator. And this person, raised their hand after I told that story and asked, well, did you also have standing instructions for when advisors were putting money in at the top of the market? And I said, no, because nobody knows when the top is. So how are you going to know? And I said, and so I told him, I said, the most important thing is not timing the market. It is time in the market. It is getting compounding returns for years and years and decades. And that's how you generate wealth. And that's how people for decades have used the greatest wealth creation machine this world has ever seen, which is our stock and bond markets, these extremely publicly traded and liquid bond and stock markets, to generate.
I feel like
so
that
much
could have been like a TED talk in its own right there. Like, I envisioned you with like a headset, and then like that statement of like, it's not timing the market, it's time in the market. And then you let it pause, and then you say it again.
Yeah.
I think it is, but it's one of my favorite like kind of quotes or comments as well, because the more you think about it, the more you realize, especially as you have more experience in the industry, it's absolutely it. It's about compounding of returns. And then I would say, going back to this notion of return, because we talked a lot about like smoothing volatility, reducing drawdown risk, more about the journey versus the destination. The silver lining in the diversification play is that, again, these unforeseen events can cause parts of the portfolio that have been unloved for quite some time to suddenly be loved again. And I think a great example of that is all these, advisors and clients who've been holding international stocks, and every quarter when they're having a portfolio review, it's like, why is this still in my portfolio? It's done nothing for me. Why don't we just move all, our equity exposure to the US? And then all of a sudden everybody's like, oh, international is kind of cool again. And so I think there actually is that, again, that silver lining where parts of these portfolios that are viewed as just diversification plays to reduce kind of the total volatility at the portfolio level can suddenly become very exciting return generating parts of that portfolio. So this goes back to the ultimate question is, does diversification dilute return potential? Yes and no. But I think everything we've discussed is really helpful. Tuning in, and that concludes our quick take on diversification.
The views and opinions expressed on this podcast are those of the host and do not reflect the views, opinions, or policies of any current or former employer, affiliated firm, or client. The content is provided for informational and entertainment purposes only and should not be considered investment, legal, or tax advice. Nothing discussed constitutes a recommendation to buy or sell any securities or investment products. Listeners should conduct their own research or consult with a qualified professional before making any financial decisions. The hosts are speaking solely in their personal capacities, and the podcast is not affiliated with, sponsored by, or endorsed by any firm or organization with which they may be associated.